to allowance for uncollectible. Right? So the actual write-off 2,700 is charged to the allowance. All right. So that would be over the balance, and you find out total. The account balance is 60,300. So what is going to be reported on balance sheet? Balance sheet will report 60,300 minus 1,890. Answer is 58,410. So guys, you understand? Let me ask one by one. So Miria, Job Hollow, Faik, understand? Subhan,
Yes, sir.
Yes, sir.
Yes, sir.
Priscillo, 10,
Yes, sir.
Mirko, PD, Nana,
Sir. Yes, sir.
okay, Noon and Oliver, understand?
Yeah.
Yes, sir.
Good. So how we are going to show on balance sheet? Simple. Net of the allowance, answer is this one. And on income statement, sales are 159,000. Simple. So that's how you account for the account receivables. The trick here is the allowance for uncollectible. And how we create that? In order to keep in mind the future possibility of uncollectible, so that our planning is not going to be disturbed. So writing off method. So you record expense when specific account proves to be uncollectible. So not GAAP, no allowance for uncollectible. Receivables may be overstated. Fails to recognize expense in the same period in which sales revenue is earned. Okay. So not GAAP, which means no allowance for uncollectible. So basically, writing off method does not follow the GAAP. Why? Because expense didn't happen, right? What is the expense recognition? You need to record expense right now when it happened. So you record expense in advance. All right? So when you are making the when you are following the standards, the GAAP, so you exclude all those. All right? Why? Because receivables may be overstated. For tax purposes, yes, the government allow you to make the income statement and you can charge the expense in advance to the income statement and your tax is going to be minimized. So that is just for information for you. So if you follow the write-off method, the journal entry to record. Okay, I think we made a mistake here. So the idea is, so there are two methods for allowance, calculating the allowance for uncollectible. I made a mistake here. I just focus on writing off. This is the method. So one is sales method and one is aging of accounts receivable method. So what if we do not include any allowance method? What if we do not plan for allowances and we just let it go? Let it happen. When it happens, we record it. So remember, law require you to plan in advance. Okay, so this method is not required by the law. Why? Because in this method we do not make an allowance. In this method, account receivables are overestimated. Why? Because those who are not planning to pay us, you still write them in your account receivable, and in that case your account receivable looks inflated and your total balance sheet balance also inflated, so which is confusing and which is not logical. All right, but The government require you to follow writing off method because judgment involved. So if it is 1% of sales, you, in order to save tax, you say it is 5% of sale, and you deduct in advance, because when expenses deducted, taxable income is small, and when you apply taxes, the quantity or magnitude of taxes are small. So government allow you to do not follow the allowance method, use direct write-off. So when we direct write-off, when there is no allowances there, so when expense happen, you directly charge to the income statement. So RS is default now. RS is not, paying us any money back. So RS2, uncollectible, expense to account receivable. All right, RS is our customer. So there is no allowance involved here. Just you charge the expense to the account. You make that account as an expense. That's it. Previously, account receivables to sales, when you sell to the RS, and now you make a reverse entry to decrease this, because we need to delete that one. So previously it is increased and now it is decreased. So account receivable decrease means debit, and because you make it an expense, so you just write it down, uncollectible expense, 9 and 9. All right, so that is easy and simplest one, but not follow the standard general accepted principle, accounting principles. Okay, so now can we compute the cash collection from customers? Yes, we can. For example, we have the entry account receivable to sales, 1800. So it would be 1800, right? And we have uncollectible 100. So can we find out? Okay, so cash received 1500 here, and your balance is 400. So even if we are not given this amount, we are given these 3 and 4. So can you find out the fifth one? So you see here that the left hand side, which is the debit side, is 400 greater than the credit side. So credit side is 2000, and yes, 2000, and the credit, debit side is 200,000, and the credit side is how much? 100. So how much is the difference? The difference is 1900. So 1900 minus 400. How much? Because 400 greater, debit side is 400 greater than the credit side. So 1500 must be the cash collection. So when you receive cash collection, the entry gonna be cash received increase, account receivable decrease. All right. So even if you are not getting this information, you can also find out the balancing figure as a collection as well. All right. Yes, I just explained you, because accounts receivable have 5 items: beginning balance, sales, ending balance, writing off, and collection. So this is just, you can also find out plug figure as well. Now, notes receivable. So the beauty of notes receivable or characteristics include: first, you have, it occurs with lending money. So you not only receive money, but also interest as well. So when you receive interest, that would be interest revenue. All right. So here we go. So terms include in receivables, they are creditor's name, debtor name, interest rate going to be mentioned, maturity date, maturity value, lump sum value is going to be written here. Okay, at the end of 30 days, 90 days, you will be paying us this amount. Principles and terms and condition is going to be written here. So we have, this is the notes receivable. And in the business world, we call this promissory note. All right. So promise to pay. So this is the amount, 1,000. All right. So signature, maturity date, interest, right? Issuance date, everything is mentioned here. So interest normally, so this 9% doesn't mean that this is 9% for August to February 2015, 6 months. 6 months, for 6 months you are getting 9%. No, interest is always given on annual basis. So it means half of the interest, which is 4.5. All right. This is the signature. All right. Now let's solve this example. So consider the promissory note. Whenever you read the promissory note, it means we are talking about the notes receivable. So after Lauren Holland signs the note, Continental Bank gives her 1,000 cash. The bank makes the following entry to the loan. When bank pay the cash, entry going to be notes receivable to cash. Cash decrease, credit, account receivable. In the case here, note receivable increase, debit. All right, made a loan. And when Continental Bank earns interest during September, October, November, and December. Why? Because this is the closing date. And the promissory note is paid on 28th of February next year. So the company's closing financial year or accounting year is